Hey everyone, how's it going? This is Richard from TraderLion, and today we're going to be closing out our CANSLIM introductory series with the M in CANSLIM. And the M in CANSLIM stands for market direction, and the truth is that none of these previous videos and characteristics matter unless the market is right. The strongest stocks in history made their strong moves when the overall market was in a strong uptrend as well, and we always want to be trading with the market. So to start things off, we'll talk about what O'Neill actually said about market direction. Number one, he said you can be right on every one of the factors in the last 6 chapters, but if you're wrong about the direction of the general market and that direction is down, 3 out of the 4 of your stocks will plummet along with the market averages and you will lose money big time, as many people did in 2000 and again in 2008. And number 2, he said the best way for you to determine the direction of the market is to look carefully at, follow, interpret, and understand the daily charts of the 3 or 4 major general market averages and what their price and volume changes are doing on a day-to-day basis. And moving on, he says, number 3, to know which way it's going, you must observe and analyze the major general market indexes daily. Don't ever ask anyone, what do you think the market's going to do? Learn to accurately read what the market is actually doing each day as it is doing it. And number 4, he said, after you see the first several definite indications of a market top, don't wait around. Sell quickly before real weakness develops. When market indexes peak and begin major downside reversals, you should act immediately by putting 25% or more of your portfolio in cash, selling your stocks at market prices. And to add on to this, when there is market turbulence, you want to be selling your weakest holdings first and trying to hold on to your kind of core positions as long as they aren't breaking key moving averages and major support levels. Moving on to number 5, he says to detect a market top, keep a close eye on the daily S&P 500, New York Stock Exchange Composite, Dow 30, and NASDAQ Composite as they work their way higher. On one of the days in the uptrend, volume for the market as a whole will increase from the day before, but the index itself will show stalling action, which is a significantly smaller price increase for the day compared with the prior day's much larger price increase. I call this heavy volume without further price progress up. The average doesn't have to close down for the day, but in most instances it will, making the distribution selling much easier to see as professional investors liquidate stock. The spread from the average's daily high to its daily low may in some cases be a little wider than on previous days. So just because the stock indexes aren't down 2% on a day doesn't mean distribution didn't occur. These type of days where there's heavy volume without further price progress up is a subtle sign of distribution, and you should be watching out for these kind of churning days as well. Number 6, he said the second most important indicator of a primary change in market direction after the daily averages is the way leading stocks act. After the market has advanced for a couple of years, you can be fairly sure that it's headed for trouble if most of the individual stock leaders start acting abnormally. And number 7, one example of abnormal activity can be seen when leading stocks break out of 3rd or 4th stage chart base formations on the way up. Most of these base structures will be faulty, with price fluctuations appearing much wider and looser. A faulty base, wide, loose, and erratic, can best be recognized and analyzed by studying charts of a stock's daily or weekly price and volume history. So definitely some very important things to remember from how to make money in stocks. And I'll also move on to talking about drawdowns. So overall, I'm sure many of you have seen a table that looks similar to this. Over here on the left, we've got a percentage loss for your entire portfolio or an individual position of 5% to 9%. And over here on the right, we've got the resulting and necessary return just to get back to break even from such a loss. So a 5% loss, you need a 5.26% return to get back to break even. But you can see that as you let your drawdown increase, you need to work harder and harder just to get back to where you were. So the key thing is you want to keep your portfolio drawdown as small as possible so that when the overall market uptrend resumes, you don't have to work too hard to just get back to your previous all-time highs, and then you can really benefit and take advantage of the strong uptrend after a major correction. And moving on, let's talk about the fish tank story and why it's so important to watch the stock market leaders. So if you're not familiar with what this story is, it's basically mentioned in How to Make Money in Stocks, and it's a story about a Harvard professor who assigned his students a assignment about fish, and many of them went to encyclopedias, they went to Google, they went to other resources, and when he got everybody's submission, he basically threw them out and told them if you want to study fish, you have to go out and actually look and watch and analyze the fish themselves. So similarly, if you want to learn about how the stock market is acting, watch the stocks, follow the leaders, and watch out for abnormal price action like stocks breaking key moving averages on volume and other distribution signs. And some key things that I like to look out for are breakouts working and following through? Is there volume coming through on the breakout? Or is it like what we're seeing right now in 2021 where stuff is breaking out, squatting, breaking that key pivot level on volume, and basically reversing hard? And another thing here, are there strong earnings gap ups, and are those stocks holding those gap up lows? All of these different things kind of provide clues about the current institutional risk appetite. And moving on, it's also very important to ask yourself, how is my own trading going? How have my last 5 trades done? Have I gotten stopped out a lot, or has stuff started working and I've made some progress over the past week or so? And this is why it's so important to kind of keep track of your own trades and practice progressive exposure. You want to scale in when things are working and then scale back when things are not. And it's also important, especially coming after a correction, that your first few buys should be focused on high quality stocks and high quality setups, because that means that those results are going to be a great test of the current market environment. If they fail, that means maybe it isn't quite time yet and you should go back to cash. But if they work, you can add some exposure, add some new positions, or increase your position size. And it's extremely important to practice progressive exposure because it makes sure that you're not getting hit too hard during those harsh corrections. And if you're not kind of profitable at 25% invested, you're not going to be profitable 100, 150, 200% invested if you're on margin. There's no sense of increasing exposure if progress is not being made. That's just a kind of ticket and quick way to get a lot of drawdowns very quickly, which, as we saw, can be very detrimental to your performance. So it's very important to keep track of your own trading and make sure that you're practicing progressive exposure. So in terms of market direction, we want to analyze the major indexes, be on the lookout for kind of reversals, clusters of distribution days, even subtle distribution days. We want to analyze the leading stocks. Are they holding up above key moving averages? Are they breaking out of sound bases? And we want to analyze our own trading and practice progressive exposure to make sure that we're properly exposed during strong market environments. But when things get a little bit more uncertain, we scale back and wait for conditions to improve. So that is market direction, definitely the most important letter of CANSLIM. I hope you guys enjoyed this video and this entire series as well. Leave a like down below if you did, and subscribe if you're new to the channel. I'll see you guys in future videos.